on line 2, we're going to combine, and this is going to be kind of odd for you, but we're going to combine notes receivable and uncollectible notes receivable. So we're going to go through that whole process, figuring out the interest, the maturity value, the due date, doing the journal entries, and then we're going to have somebody dishonor a note so that you have to see, you can see how that is handled also, which is just like an accounts receivable. So we are looking at not 1, 2, or 3, but 4. And this one's asking you, what is its maturity value? Well, I've already given you the answers. You have to give me the calculations. We'll kind of reverse this a bit. So you will do that and figure out what the calculations are to come up with this amount. And then you're going to journalize and record the due date, record the when the note was taken out, and then you're going to do an adjusting entry for October 31st to record the accrued interest revenue on all 3 notes. And this is what it's going to look like. Okay, first here's where you establish them, 1, 2, 3, and then adding all that together, all of the interest together, this is the accrued interest. You need to show the calculation down here again. So what are the originating entries, and then how do you calculate and come up with $909 worth of interest? Okay, so that, and then in 3, you're going to record the full amount when you when they pay it off. Okay, you're going to record that full amount, the maturity value on it. And you'll notice there's some, interesting things here. You've got an accounts receivable, and you have an interest revenue. Remember in the other ones that we did in a prior, in 9-1, how if we had a receivable up here, we had to decrease that receivable and show it as being complete, and then only show the revenue for the amount of time of that year. So you'll have accounts receivable from up here, where you interest receivable is actually the interest, I was calling it accounts receivable, I'm sorry. The interest receivable will be credited, whatever this entry was, but you'll have to separate it out for each one, whichever interest is for each one. And then you have for note, this only shows for, here's 1, 2, and 3. Please note that note 1 is not followed by note 2. Okay, it's because of the way the dates are set up. So get them in the right order, or when you're calculating, make sure you're calculating the correct one, and they're marked right here. Should be an interesting exercise. Email if you have questions on that one, or message me. But it's fairly straightforward. I think you'll be fine. It may be challenging. So for 5, okay, you're going to do the same thing. You have a note receivable. This one actually moved from accounts receivable to a note receivable. Here's their accrued interest on the 31st. This actually says, okay, I want you to close the revenue account. Now, a revenue account gets closed by debiting and crediting the income summary. Go back about 3 weeks ago when we were doing closing statements. So you might want to look that up. So we're bringing that in. And then in February, we have another transaction from Hey There. You've got some cash. You have receivable. They must have paid off. They must have paid a note. And then you have Pop Music has a notes receivable. And Union Music has a notes receivable. So you're kind of just getting notes receivable left and right here. And let me see what we have going on at the end of the year, or it looks like the end of the year. So if you look at July 1st, let's go here, you loaned $15,000 out to Pop. And October 2nd, you received a $2,000 note from Union. That is a sales revenue, okay? That's a sales revenue. This is a loan. There's a difference in that. Then on December, Union dishonored their note at maturity, and you wrote off the note as uncollectible, debiting. It actually tells you what you're going to do. You're going to debit the allowance for uncollectible notes for that amount, and then obviously credit the note receivable to get that out. And then on December 30th, they came back, and then Pop Music from up here paid their note, okay? They collected the maturity value of that, and the calculation is right here to help you. It was an 8% note receivable for a half a year on $15,000. So you're going to separate that out so you can find your receivable. This will take it out of, okay, here's your revenue. Here's your receivable you're going to remove, and then this will be the full amount of cash that you receive. Make sense? So you're just going to take each entry and record it. Now what you really want to do, especially when you've got multiple entries like that, I really seriously always do put underneath the amount, the interest rate, and for how long. Simply because you'll forget. Even up here, I seriously would have put the amount and the interest rate and for how long. That's just really a lot easier for you when you go back to do entries like this. At least make a note of it for yourself, because you really can get lost. So that may be a little bit confusing, but if you notice, we're now pulling in other parts of accounting into the entries so that you can see how they're truly used. Such as this one, we've started with an accounts receivable. We've taken it out of accounts and put it into a note. We have asked you to do a closing, which you've done previously. Here, this is a loan versus a sale. So you're kind of comparing how the two would look and what the difference is. Here, we're actually taking a note receivable and using an allowance account for it. Before, we've just kind of used accounts receivable as that. And then here, you're just doing a typical maturity value. So they've combined everything in this one problem. And I think it's a good problem. So if you have problems with it, please give me a message and I'll try to help you out here.